Good day, my name is Herman Wheeler from PSG Wealth Northcliffe and welcome to our second video production. We send out this link with our newsletters that you will receive soon. During this discussion, we want to focus on the cyclical nature of the market. In this game, there are four players: cash, bonds, property and equity. We want to focus on cash and equities. If we look at the performance of these two asset classes since the inception of the JSE, and if you were invested in cash and you consider the impact of inflation, then you would have doubled your money every 90 years. In equities, you would have doubled it every 10 years. Therefore, we will agree that we want to participate in the equity market, or at least have a healthy portion of our portfolio invested in equity markets. Unfortunately, there is a but. As you can see in the graphs, the equity markets move rapidly or quickly up and down. This happens, and it always will happen this way. During periods where the market performs well, investors become bullish, prices rise, and a sense of greed enters the market. During periods where the market underperforms, investors become cautious, they don't want to participate in the market, and fear enters the market. Let us look what caused the markets to tumble during 2022. Firstly, inflation in the US and worldwide. Secondly, the war in Ukraine impacted on energy, food, and other commodity prices. And thirdly, the lockdowns in China impacted severely on supply and demand chains. What we've also seen, specifically in the US market, that the tech sector's bubble came to a halt. Some of these counters is detracted with 70%. In a strange way, this correction, or can we call it a market crash, is healthy for the market because the share prices now reflect a fairer value to the underlying asset. And from this, it's easier for a bull market to come forward. What lessons do we need to learn, and what message do we want to get across to you as investor? Firstly, the markets move in cycles, and it will always do in the future. If we look at the next graph, and specifically the S&P 500's 50 best days from 1980 to 2022, 46% of the best 50 days came in the bear market. If we relate this to our own JSE and we reflect on the last 20 years, if you did not participate during that best 50 days, your returns from 13% would have fallen to minus 1.8%. That's a significant margin. What are our expectations for equities during the next 12 months? Domestically, you can expect returns between 12 and 16%. Offshore equities, returns between 10 and 12%. In summary, and from all of us at PSG Wealth Northcliffe, we wish you and your family all the best during the festive season. Please take time to rest and connect with your loved ones. If you travel, be safe on the road and be assured that your investments are managed with diligence and care by all of us. Until next time.